It's the moment we've all been waiting for, the eve of the FOMC interest rate decision. And of course, that is a highly anticipated not only decision, but press conference with Jerome Powell tomorrow. And so it should not come as a surprise that the first couple of days this week have been rather quiet. However, there are always some interesting developments, and we try to uncover them in these nightly videos. And tonight I wanted to talk about the underperformance of mega cap tech once again, which has seemed to be a continuing theme here recently. We actually ended up having more stocks up than down in the market today, despite the end result of the market being lower as a result of that mega cap underperformance. We're also going to have a conversation about interest rates and inverted yield curves, what's been going on with the dollar, how that's impacting foreign investment. We're also going to have a conversation about sectors, where the rotation is taking place from a price perspective. And then lastly, we're going to talk about our trade application example, where I wanted to feature a bearish trade on a technology stock that's a little bit more speculative than I typically will deliver, in the hopes that if there is a give back tomorrow as a result of the interest rate decision, that we have a few bearish trades in the hopper. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's November 1st, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list, so that way you can be notified whenever we post these videos. Remember, at the bottom of those emails, you'll also find which stocks are giving you overbought or oversold cluster signals within the S&P 500. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee as my handle. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address in the logo in front of you. All right, let's jump into today's trade activity. And per usual, we've got our S&P 500 heat map pulled up here in front of us. And as always, been kind of an interesting time that we've been going through here. Of course, we've had lots of earnings announcements to sink our teeth into in the last couple of weeks. But in addition to that, many of you should be aware. If you're not right now, let me inform you that tomorrow should be a volatile day. Tomorrow is the interest rate decision from the Federal Reserve, and it is highly anticipated, one that we've been kind of wondering about for quite some time. Of course, the market has been roaring here. Many of you have followed my tweets and things like that over the weekend, might have seen some historical statistics. One of the more important ones, or at least eye-popping ones, is that the Dow Jones Industrial Average just had its best month in my lifetime. Not to date myself too much, but I was born in 1978. The last time it happened, where the Dow was up over 14%, was 1976. So that's really saying something. Now, naturally, part of the reason behind such an aggressive move higher was the fact that, of course, the stock market was down in the doldrums in the month of September. But there was also an element of, a shift towards more value-oriented investments, like we talked about in the video on Thursday when I shared those ratio charts with you. So anyway, the end part of that move has been quite interesting to witness. And part of what I wonder is, if we would have gone up as aggressively and as consistently as we did, had the Federal Reserve not been under their quiet period that they traditionally have before their interest rate decisions. It seems like earlier this year, whenever we'd get a little bit of momentum going to the upside, the Fed and the Fed governors would be quick to come out with their various speeches and interviews and try to talk the market back down. But this time around, they weren't allowed to do that because of the quiet period. So what happens tomorrow? We shall see. My own hunch is, I think we're probably going to have to give some of those gains back, but I sure hope I'm wrong. So these have been some of the more interesting times to be involved in the markets here recently, and I'm sure a lot of you are, sitting at the edge of your seat like I am, waiting to see what will happen tomorrow. And then in addition to that, remember, this is also an important week because it's the first week of the new month, and remember, the first Friday of each new month is when the jobs numbers get released. So we'll get a little bit more economic data that could impact markets in and trading here at the end of the week as well. So buckle up. It should be some interesting activity here in the next 3 days or so. Let's take a look at what happened here today on Tuesday in the normal market session. And you can see it was a little bit of a mixed bag. It kind of looks to me like we had a few more stocks in the green than we did in the red, but it reminds me of one of the days I was with you last week. I can't remember if it was Thursday or Tuesday, but one of those days we had that situation where we had more stocks that closed higher on the day, but because the mega caps were down so aggressively, it actually forced the S&P 500 lower. And it kind of feels like we're having one of those similar situations again today, because as you look at this, you probably see a lot more green squares and rectangles, but of the biggest squares and rectangles out there, they are largely in the red. One in particular that catches my eye here in the red, Amazon, down 5.5% here today. And some of you might have seen my tweet about this earlier today, but they have lost their trillion-dollar status as of today as well, with the stock trading now pretty well below $100 per share. Remember, they were a $150 stock not too long ago. So just like that, you've wiped off hundreds of billions of dollars worth of market cap on a very important company in our world today, Amazon. In addition to Amazon, there was also some selling that took place in some of the other mega cap stocks, like Microsoft was down 1.7%. Apple was also down 1.7%. Alphabet was down 4%. Some of you saw my meme on Twitter here just a moment ago about the husband and the wife that are in bed, and the wife is wondering what the husband might be thinking about. If you're wondering what I might be thinking about, you should check my tweet there. As a dividend growth investor, you probably have at least an idea. But in today's normal market session, Alphabet, as just a growth stock that does not currently pay a dividend, was down 4%. You can also see that United Healthcare struggled today. It was down 1.4%. We saw Eli Lilly down 2.6%, and even Johnson & Johnson was down 0.5%. Mentioning them specifically not because they had a big move lower, but Johnson & Johnson was in the news today. Remember, they are a very important company to many of us dividend growth investors. Not only are they a dividend aristocrat, meaning they've got 25 years in a row or more of increases, they are a dividend king with more than 50 years in a row or more of increases. And on top of that, they are one of just less than a handful of companies that have a AAA balance sheet in the United States. They actually have a better credit rating than the U.S. government. So they were in the news here today with a pretty splashy acquisition of Abiomed, which had been a pretty hot growth stock over the years. And now today we learned that Johnson & Johnson is buying them out. Remember, Johnson & Johnson will be going through a bit of a split here in the future where they're going to be spinning off some of their divisions. So it'll be interesting to see how that all shakes out. Let me see if I can find Abiomed here. It's probably one of these green boxes. Yep, there it is. Abiomed is a big enough company to be in the S&P 500. It's a $17 billion company. Many of you have probably never heard of it before, but it is a fairly large player. And as you can see, that's not a typo there. That stock was up 50% today. That's what happens when you get a really nice premium from a deep-pocketed healthcare provider like Johnson & Johnson. In addition to Abiomed going up nicely, we also saw Hologics up 9%, and then IDEX Laboratories up nearly 10% there as well. So a couple of big winners there, in addition to a lot of those mega cap losers that I had mentioned before. When it comes to consistency across the various sectors, I'm not really seeing it today the way that it's a little bit more obvious to my eye when I'm sharing this information with you guys. What I would say is that it kind of seems to me that the energy area was more consistently green, and the utilities area was also a little bit more consistently green. But for the most part, it was kind of hit and miss out there with the rest of the sectors. I mean, you had ample amounts of both green and red given today's kind of choppy action. I do notice that Marathon Petroleum was up about 5% today. Remember, this is the refining one. There's a couple of marathons. The exploration and production one is MRO. This one right here is MPC. I'm pointing them out not just because they're up 5% today, but they also increased their dividend by about 20% here today. So nice increase announcement out of that one as well. So anyway, a bit of a mixed bag here on the S&P 500 today in terms of winners versus losers, but decidedly negative tilt towards the mega caps, which do have more sway on the overall impact of the S&P 500 as we head into tomorrow's very important FOMC announcement. The other thing I was going to mention is that, remember, today was the first trading day of the month. I hope all of you had a wonderful October 31st Halloween here last night. I enjoyed taking my little munchkin out and around the neighborhood. But today is the first day of the new month, and many of you are aware that the first trading day of a new month traditionally is a bullish day. It's actually surprising, if you were to go back and look at the statistics over time, how much of an impact on the overall gains are the direct result of just 12 days, and those are the 12 first days of the month out there. If you're interested in more of that information, you could pick up a copy of the Stock Traders Almanac, where they go through a lot of that information. But anyway, if you're ever on the fence on the day before the first day of the month, typically you're better off deciding to buy or be on the bullish side of the equation for the following day. Today, it did not pan out that way. It looked like it was going to, because we actually had a pretty nice jump out of the gate this morning. As the S&P 500 was up there above 3,900, but it quickly unraveled and ended up closing down about 0.5% when it was all said and done. All right, let's go ahead and now pop on over here to the main part of the platform, take a look at some of our breadth numbers, and as you can see, we did have 281 stocks out of the S&P 500 closing higher, so that is a hit rate of about 56%, and again, we'll mention that even though the S&P 500 itself was down 0.44% today, or whatever it was, about 0.5%, we actually had more stocks closing up today. And again, that doesn't happen a whole lot, but because of the market cap weighted aspect of how the S&P 500 is priced, that can happen on days when the most important and biggest market cap companies are largely lower, even if the rest of the market is largely higher. And again, there's that one bar that stands out pretty dramatically here. Usually these bars don't stand out this dramatically, but this is quite an impressive 50% candle there out of Abiomed as a result of that takeover that I had mentioned before. So today was one of those where you had more stocks close in the green than in the red, but if you just picked up a copy of the Wall Street Journal and looked at what the result of the S&P 500 was, you probably would not have recognized that. All right, let's go ahead and pop on over here to the charts now and get into some charting analysis. This is chart 4B. For those of you who are premium members of Market Scholars, remember all of our premium members get access to our 50 plus customized charts that you see David and I using. And remember, we're now in the month of November, where we do a very rare sale here at Market Scholars. I'm sure we'll be sending information out to that regard here soon enough, but as we head towards Black Friday, stay tuned if you're interested in joining David and I at Market Scholars for a more full-fledged education. We'd love to have you, and we'd love to have you save a little bit of money as well by doing the Black Friday sale a little bit later on. So stay tuned on that. I'm sure we'll let you know in these videos, in addition to sending out the emails like we typically do each year. All right, let's get into chart 4B here. And as you can see, the S&P 500 was down for the second straight day. It was down 0.41% when it was all said and done. As you can see, we kind of closed at the lower end of the trading range today, but it was a quiet day. And remember, that was expected. I think most of us were anticipating that both yesterday and today would be quiet. I didn't necessarily know whether the days would be up or down, but I figured they would be somewhat muted in their volatility as a result of everybody just kind of waiting with anticipation prediction on the FOMC decision tomorrow, where there should be more volatility. Now, sometimes that doesn't happen, but more times than not, new information gets released to the market in the middle of a trading day. Remember, that's a rare situation where information comes out at 2 p.m. Eastern time. A lot of other economic data gets released before the markets open. So that's kind of a unique aspect of that as well, where you have tremendous amount of volatility because you get the release and everybody's trying to interpret it on the fly. And sometimes there's some whipsaws and some head fakes that take place as a result of everybody trying to make heads or tails out of the information as quickly as possible. So tomorrow I would anticipate a bit more volatility. But for today, notice that we had blue labels up at the top on all four of our charts, basically meaning that today's daily range was smaller than the average true range, or what the recent ranges have been on average here recently. So a quiet day across the board, but one that did lean more bearishly for most of these indices. Despite the S&P 500 being down 0.41%, you can see that we do remain with a strongly bullish posture on the S&P 500, with that dark background color kind of implying that we have that green line in a positive territory, and in this case it's actually in the upper reversal zone above 80. It's at 83 and rising right now. In addition to that, the S&P 500 does display a green moving average. That's a 30-day moving average, and when it's green, it means price is above a rising moving average, and that's generally a more bullish feature as well. And like I mentioned last week or the week before, there has been more constructive activity on the chart, where it's nice to see us actually holding above this 30-day moving average, which in the past that hadn't necessarily been the case. It's also nice to see that we've been largely not just holding above the moving average, but holding above this previous resistance area from the first week of October as well. But I think we also know that technical analysis is one thing, news is another thing. And tomorrow, news will challenge technical analysis. And if the news is received poorly, then even good-looking charts can flip the opposite direction. So we have to be mindful of that as well. But without a doubt, it's been an amazing run. We talked a lot about that in my dividend growth investing class here for my premium members earlier today, and talking about how the run really started right here with this bullish engulfing candle in the middle of October. We were talking about the amazing result of the Dow and some of the other indices for the whole month of October, but the truth is the first couple of weeks of October really weren't anything special, and so that kind of it makes it even more impactful in a way to know that the whole month was a historic month to the upside, and it really didn't get going until the last couple of weeks of the month. So it's been really, really interesting to watch this all play out, and it kind of feels like there's a little bit too much bearishness in the system that needed to get worked out. Notice all of these cluster signals that we had talked about during this stretch run here, where we rarely saw clusters coming in at that consistency. Like we had 5 days in a row of clusters, right? That hardly ever happens on the S&P 500. So, getting a snapback rally was certainly something that was a possibility, and in some cases a likelihood. You can't go down day after day after day forever. You eventually get some sort of a snapback. But the question is, after you get the snapback, where do you go from there? And generally, I'm a little bit more hesitant around the idea that snapback will represent an actual trend change. My assumption generally is we get a snapback, but we stay within the longer term trend wherever that was from. With the bullish clusters, of course, the longer term trend in this case was bearish, and it can be the opposite with the other side of the coin as well, when we start getting bearish clusters on the upside where the previous trend was bullish. But if you look at, let me just pull up like a longer term chart here to make this kind of sink in perhaps a little bit more. If you were to look at this activity, this is a monthly chart now, this is a 20-year monthly, so it's a lot of data. But if I were just to kind of zoom in on what we've been dealing with here recently, with this month of October, which again was a very impressive one, would you say that downtrend is broken? And it's debatable. I don't think that it is. But you could see that, depending on how you drew your trend lines, some people could maybe make the case that actually is true. And so this longer term view, I think, is helpful in trying to keep us a little bit more cautious going into tomorrow than we would otherwise. A lot of times you would look at the chart. Again, let's go back to the normal 3-month view here, and you look at what's been happening lately. And it looks pretty promising, right? That's a good little bounce back and things are improving there. But then when you start putting that in the context of the fact that you're still in a prolonged monthly downtrend, it kind of, starts to have you, cool off in terms of you getting too excited to the long side of the market. So tomorrow will be an important day. Will the bulls be able to build upon what they've started since the middle of October, or will Jay Powell, now that he no longer has a quiet period to deal with, will he basically do his best to talk down the stock market? Remember, his goal can be counter to our goals as investors. Most of us want the stock market to go up, especially those of us that have long-term retirement accounts and all that kind of stuff. So most investors want to see stocks go up. And Jerome Powell is saying, my job is to make sure that inflation gets stamped out. And one thing that leads to further inflation is the wealth effect. And the wealth effect is largely driven by increases in the stock market or real estate or different things like that. And so in a lot of ways, it's a little bit self-defeating to have the stock market go up as aggressively into the Fed announcement. And I think it sets up a slightly higher probability that the markets may have to give some of those gains back. Again, I hope I'm wrong, and we'll all find out soon enough. But I, for one, am kind of approaching tomorrow with a somewhat cautious attitude, despite the recognition that we've had a really nice bounce here of 12, 14%, whatever it has been from the lows. It's been a really good bounce, and a lot of our account balances have responded in kind. We're talking about that in my DGI class today as well, because a lot of us dividend growth investors have portfolios that look more like the Dow than it does the Russell, the NASDAQ, and the S&P 500. The Dow is where you kind of have your big blue chip companies that oftentimes pay dividends. I think there's only 3 Dow companies that don't pay a dividend. So, as dividend growth investors, if we were to look at one of these 4 indices and ask ourselves which one is the one that is most closely aligned with the way that our portfolios are constructed, it would be the Dow. And of course, that's the one here in this current moment that's done spectacularly well, done much better than some of these other indices. And so for those of you that are longer term dividend growth investors like I am, you're probably going to be pleasantly surprised when you look at the account balance on your October brokerage statements. Again, whether that remains is another question, because we have a tough challenge in front of us in all likelihood starting tomorrow, as we are somewhat at odds with what Jerome Powell's goals and wishes are at this moment in time. And so he can have the tendency to come out and try to talk that market back down and kind of spoil everybody's fun, so to speak. Speaking of the Dow, you can see that it was down 0.24% today. So once again, the Dow outperformed the S&P 500. It outperformed the NASDAQ composite. But in today's case, the Russell 2000 actually did beat the Dow. But nonetheless, the Dow is retaining its strength. And as you look at the Dow versus these other indices, what I'd like to point out is the fact that the Dow is by far and away the highest above its 30-day moving average. In addition to that, it is much more obvious to the naked eye that you do have a bent 30-day moving average, bending higher, right? With these other two, they're colored green, so we know that they're going up, but it's hardly visible with the naked eye. Here we can see it without actually going into the fine numbers themselves. Here we can see it with our eye that line is actually going up now. So the Dow has been just a behemoth here. It has been, like the Incredible Hulk, if we're still in Halloween mode here, just pulling the rest of the market up with it. And while it's still a ways away from its 3-month high that it set back here in the middle of August, it's the one that stands the best chance of breaking that high if we do get a bullish move out of the FOMC announcement tomorrow. Because remember, that's a possibility too. Maybe Jerome Powell comes out and says, you know what, guys, we've been way too aggressive here, and we see the damage that's been done. Mortgage rates are going to crush the economy. We're going to take it a little bit slower from here on out. Again, I doubt he's going to say that personally, but he could. And if he does, the market might interpret that like, hey, we're closer to the end of this rate hiking cycle than in the middle or at the beginning or what have you, and stocks could erupt tomorrow. Who knows? And if they do, then it looks to me that the Dow is the one that's most likely to break to multi-month highs first, right? So that's where our leadership group is right now. To me, it seems like the temperature changed on that scenario when JP Morgan reported their earnings here a couple of weeks back. Remember, they were one of the first big Dow components to report. And it just seemed like they set the tone for the mega caps from the kind of value mega caps perspective, not the technology mega caps perspective. And the Dow has been kind of a leader ever since that moment. You can also see here that they have a strongly bullish posture, no surprise there, in addition to being above their rising 30-day moving average. Down below here, let's talk about the NASDAQ now, because that is our weak link at this moment in time. And you can see that the NASDAQ sold off once again today. Again, not a surprise after learning what we just went through on the heat map, where Amazon was down 5% and Alphabet was down 4%, and Microsoft and Apple were both down over 1%. So a tough day for mega cap tech, and that's going to have a bigger impact on the NASDAQ composite than it's going to have on these other indices. So not a surprise to see the NASDAQ did the worst today. It was down 0.89%, and that was enough to actually change the background color from green back to pink, meaning that this green line has started to roll over down below, so our intermediate posture at 54 and falling would be back to weakly bearish. On the flip side of the argument, you can see that we did manage to close just barely above the falling 30-day moving average in this case. It was really close, so it's probably just a few pennies away. So if there is a continued sell-off tomorrow in the NASDAQ, you will likely see the color of that moving average go from yellow to red. So keep on the lookout for that. But again, it seems like the tech stocks are the area where we are finding our struggles. And remember, when I did the bearish trade, I think when I was with you on Thursday, that was in the tech area with Zscaler, I think is the one that I did. And so that's the area that I think is still more prone to finding bearish setups at this moment in time. Again, notice how the NASDAQ is sitting basically right on its 30-day moving average. Notice these other indices all have air pockets between where they're trading and their moving averages, telling us that this is the weak link here, the one that just cannot keep up with the other markets at this moment in time. And remember, in a lot of ways, it's just them giving back their gains over the years. The NASDAQ has been our leader for years and years and years and years. So for once, they're in the opposite side of the equation, where they're actually our laggard. And, it's possible they could be a laggard for quite some time because of how much outperformance they had in the last, decade to 15 years. NASDAQ stocks have just been crushing everything else out there. So now that we're kind of in a little bit more of a negative sentiment from a broad markets perspective, those tech stocks, the very ones that let us higher, are the ones that are the most vulnerable to the downside. So we've got to be a little bit more, cognizant of that. Off on the right-hand side here, lower right, we've got our Russell 2000. Remember, those are our small cap stocks in the U.S. And as I mentioned before, they were the only index to actually close higher today. Now, they still closed near their lows, so there was a gap up in the Russell today, and then they ended up closing close to their lows of the day, but it was still higher than yesterday's close. And so they managed to eke out a 0.25% gain. And in doing so, that allowed them to retain their strongly bullish posture with that dark green background color there. Notice their green line is in the upper reversal zone. And then we also have that green 30-day moving average still. So price is above a rising moving average, even if it's not quite as obvious as what's going on with the Dow Jones up there. So I would say that the Russell 2000's done a pretty reasonable job staying bullish, all things considered, here as well. In fact, if you were to look at the actual readings of the intermediate levels, the Dow as the leader has a intermediate reading right now of close to 94, whereas the intermediate reading of the Russell 2000 is down at 88, but that is still higher than the 54 on the on the Nasdaq Composite and the 83 on the S&P 500. So it's clear that the Dow is our leader. It's clear that the Nasdaq is our laggard, and between the other two, I would say that the Russell 2000 is probably doing a bit better than the S&P 500 itself. All right, let's go ahead and step on over here to the internet. And I always like to get a chance to say thank you to everybody who helps support this presentation. I don't get a chance to look at a lot of the YouTube statistics and things like that because that's kind of David's venue there, but he was mentioning that we've been getting some super thanks out there. And so we really appreciate that. Wanted to mention that here as well. So thanks to all of you who contribute there. But as you know, one way that we try to judge our success with this video is how much of an impact we make with social media, right? There's a couple different goals of this video. First of all, we want to help educate you, but you have to remember we're educating people all day long as well, so we don't need to do it again for free on YouTube. So part of it for us as well to try to get the name out about Market Scholars, and that's where you guys come in. And if you're willing to click like and retweet and all that kind of good stuff on social media, that goes a long way for David and I because we're a very small company, right? It's just the two of us. And so you guys can get the word out about our organization much better than David and I can on our own. And we recognize that early, which is why we try so hard to do well on social media. And you guys have been very accommodative around that. Believe it or not, we got exactly 100 likes this time around. So whoever the last one was, and I think it was Arth, I went and checked because it kind of shows the order of when the likes come in. So Arth, if you're listening, you are the reason that I'm still talking right now, because remember, if we're up or over 100, I will be doing a full-length video, including a trade application example. If we're under 100, then I would just do a 15-minute quick hitter video on only the 4 indices themselves. And so I would already be done if Arth and the rest of you 99 did not click like. So thanks to all of you who did that. I really appreciate that. Please keep that up, and I'll offer you the same opportunity when I'm scheduled to do the video again on Thursday. If you want to hear my reaction to the Federal Reserve and everything that might be taking place that day, then I have one simple, small request from you. It doesn't cost you a single penny. All it does is cost you 5 seconds of your time. Just click like for me there on Twitter. And remember, we've got this little Twitter widget embedded below where you're watching it on our website as well to make it nice and easy for you, so that way you don't have to go hunting around for it. Otherwise, it is pinned to the top of our timeline for those of you that spend time on Twitter like David and I do. All right. Also, let's go ahead and take a look at some of the content I've been putting out here recently. Sometimes you see these recent blog posts on the right-hand side here, and one of them here says the dividend stair-step sector statistics. I did post that last night on Halloween, and that is available for free. I always like to point that out in these presentations as well. The way that our business model works, like a lot of companies, we offer some stuff for free, just like this YouTube video that you're listening to right now, but the majority of what we do is behind a paywall for our premium clients. And so one of the things that we do offer for free are some of these dividend investing blog posts. And if you're wondering where to find those on our website, just go to marketscholars.com and then hover your mouse over blog and click on dividend growth investing as that category right there. You can also find it in this drop down area where it says categories, and click on dividend growth investing right there if you want. So anyway, last night I posted about the sector attractiveness based upon the dividend stair-step charts I use in my DGI classes to determine which sectors look like better opportunities from a purely yield versus average high yield perspective. And some of those areas that are more attractive are the ones that have been getting beaten up price-wise a little bit worse this year. Things like communications and discretionary are more attractive for new money right now because their dividend yields are higher because their prices have fallen. On the flip side of that, at the bottom, you see healthcare and energy. They are somewhat less attractive for new dividend money right now because, of course, their prices have done better this year. And when price does better, then dividend yield goes down, all else being equal. So feel free to spend a little bit of time working through that information if you are interested. And then in addition to that, here, hot off the presses, just here about an hour or so ago, I got done putting the finishing touches on the new dividend increase announcements from the most previous month. And so that was, of course, the month of October. And you can see that there were lots and lots of companies that were reporting their dividend increases last month. And you might be interested in kind of evaluating them and analyzing them on your own. This will give you some of the information about what size of an increase it was. So like Visa came out with a 20% increase here last month. It'll tell you how many years in a row of increases there are. So there's Black Hills from my state that I grew up in back in South Dakota. They have grown their dividend for about 52 years now. Northwest Natural, by the way, up in the Portland, Oregon area, has grown their dividend for 67 years in a row. And then, of course, these days, there's quite a few high yielders out there because when stock prices go down, dividend yields go up. And so there's a lot of good stuff to kind of sink your teeth into if you're interested in dividend stock analysis. And again, you can find this post in that same area that I showed you before. Just hover your mouse over blog and then come down to dividend growth investing. And that's available for free for everyone. You don't need to have a premium membership for that particular information. All right, let's also have a little chat here about the sector selector. A reminder that I put this together on Friday evenings. And so it is a couple of days old at this moment here on Tuesday night, but can still give us a broad sense of what's happening from a sector rotation perspective. And remember, this information is driven purely by price. It is not driven by fundamentals or dividend yields or anything like that. This is entirely by price and is something that we use in my top-down trend trading room on Monday mornings, where we focus on the momentum style of trading in that particular class. But we try to not only buy stocks that are relatively strong, but we want those stocks to be in relatively strong sectors and relatively strong industries as well. And so this is one of a couple of tools that we use in that class, in addition to our stock selector tool, which will get us a little bit more into the industry analysis and some of our holdings and some of the stocks on our watch list and different things like that. So let's have a chat here about the sector selector. As you can see, it was the 5th straight week of energy in the driver's seat. No surprise there. Remember that oil and gas has been one of the few areas, the few bright spots in the market this year. All you have to do is look at a chart of something like ExxonMobil, once a company that was on the brink of disaster just a few years ago, to now being back up there very close to all-time highs, and apparently making a lot of enemies in Washington, D.C. Because of the amount of profits they are making as an organization, which I don't like to get political because, truth be told, I've voted for plenty of Democrats and Republicans, at least in the presidential races. So I'm not a hardliner in either direction. But I always find it somewhat amusing to see politicians start talking about profits, and too many profits in this case, when politicians would not have been willing to give them the benefit of the doubt a couple of years ago, when most of those oil companies were bleeding losses, right? If you're not going to bail the oil companies out when they're doing terribly, then you shouldn't expect to vilify them when they're doing better. But hey, politicians are going to play politics. I think we all recognize that, and quite frankly, we probably can't blame them, right? If we were in their shoes, we would probably be doing the same thing if it meant that we would get a few more votes here or there. So it is what it is, but hopefully those of you that are a little bit more well-versed in the financial world can kind of see through the political theater for what capitalism actually represents here in the United States. And it is true that oil and gas companies are one of the only bright spots of our entire economy this year. In fact, the S&P 500 earnings without the oil companies would be going down this year. So earnings are expected to go up by maybe 3 or 4% this year, and that is entirely due to the oil and gas companies. If it wasn't for them, then obviously our economy would be in a lot more tatters than it actually is. And so, love them or hate them, the facts are that oil and gas companies are up at the top, and they have been more times than not for most weeks of this calendar year. Now, somewhat interesting, we do have a number 2 that is new, and that is financials. And as you kind of track backwards with this darker shade of green and this ball, you can see that they have never been up there to number 2 in the last 3 months. This is a rolling 3-month graphic that gets updated every week. And so this is actually the highest positioning of the financials. And again, I think there was a sentiment change the day that JP Morgan reported their earnings. And so many of those companies could start to benefit from a momentum perspective in the stock market as well. And then we do have industrials and healthcare rounding out our top 4 up there at the top. At the bottom, you'll notice that, again, communication services has been at or near the bottom for the vast majority of this calendar year. But recently, they've gotten off the exact bottom like they were back here at the end of September, and they've been replaced by the 2 most interest rate sensitive sectors out there, utilities and REITs. Both of those areas tend to do relatively poorly when interest rates go up. And that has certainly been what has been happening here more recently. And so it looks like they're in the penalty box for the time being, but if interest rates ever do start slipping once again in the future, they might have an opportunity to find some value in those areas. If you're not a momentum-based trader, then maybe there is longer-term value that will start emerging from some of these areas down at the bottom as they have more attractive PE ratios and more attractive funds from operations, more attractive dividend yields, and all that kind of good stuff as well. All right, let's go ahead and now pop back on over here to the main part of the platform. And let's do a bit of 12 grid analysis, starting with chart 5A. All right, so this is our asset class 12 grid, and my eyes for much of this year have immediately gone to the bottom 2 corners because I know that that is what the stock market is concerned with here in calendar year 2022. So let's start our conversation down there as we so often have this year. In the lower left-hand corner, we have the US dollar. And the US dollar's chart has gotten pretty sloppy. It's actually gotten a little bit more bearish with that breakdown that took place there in that 3 out of 4 day sell-off that we had kind of at the end of October there. Now, we have had a little bit of a response to that, a little bit of a reversion to the mean, but this is kind of what I was referencing before when I said that my assumption is that when you have a broken trend line or a moving average or something like that, and you start getting what appears to be too much selling taking place, you can start assuming that there will be a reversion to the mean, but that reversion to the mean doesn't necessarily mean that there's going to be a legitimate trend change that takes place. And that is what's kind of going through my mind right now. And I don't know the answer, but I am wondering about it internally because the dollar has been a very strong asset class for much of this year. It's really only been the last month and a half or so where that hasn't been the case, right? If I were to pull up a 1-year chart of this instead of a 3-month chart, there we go. You can see that it started in the lower left and it's ending in the upper right. But it's also true that we've had a little bit more chop and slop here lately. However, this has also happened back here in July, end of July, beginning of August, in that time period right there. We also had it take place to a degree at the end of May here. So this is not the first time it's kind of broken a bit through the moving average and started to get people to wonder, is the end near for this rising US dollar environment that we have? And we have then found out in hindsight that the end was not near and that the dollar recouped and continued in that upward trajectory. So this one's a tougher one for me at this exact moment in time because while we've had this nice little reversion to the mean move here in the last week or so, all we've done is gotten back to the moving average itself, and then today we did sell off just a little bit. It actually was a worse sell-off intraday, but by the time the day was all said and done, we actually ended up only closing lower by a penny on UUP. So There's a little bit of a battleground that seems to be taking place here, and in all likelihood, it's going to be sorted out tomorrow, right? If we expect volatility across a lot of different asset classes, the dollar will be right part of that conversation as well. So it's possible tomorrow is a very important day for the dollar. Do we break back above the moving average like we saw back in July and in May, when it looked like, hey, there could be a possibility of it breaking down, but instead it went back up? Or is this a sign of things to come, what we've recognized here over the last few weeks, where we have some broken support levels? Maybe that's just what we needed, right? Things can't go up forever. And so eventually the US dollar will have to roll over. It's just a matter of when. Is this the moment that it does it? Well, right now that is to be debated, and it's too hard to tell. It's sometimes you got to have these things that go in the too hard file, and when the evidence becomes more clearer, you can make a better judgment call on that. And I kind of feel like that's where we're at with the US dollar right now. It was down today. You've had some broken down support levels in recent weeks. But on the flip side, you do have a weekly bullish posture with that light green background color there as well. And the moving average is still rising. So you could really see either one of these scenarios playing out. But again, I think tomorrow things might become a little bit more clear there. On the other corner is the 10-year U.S. Treasury yield. And the 10-year Treasury yield has been like the enemy of the stock market this year. As yields have gone up, the stock market has largely gone down. And then in the last few weeks, when yields have finally started going down a little bit, is when the stock market has decided it could go up. So those two are kind of mortal enemies in this year. And again, tomorrow is going to be such an important day because not only are we going to get the interest rate decision, but we're also going to get a legitimate kind of press conference with Jerome Powell. Remember, the last time that a lot of people heard from him was at Jackson Hole. I remember that because I actually went with my family to Jackson Hole the following week. So first time I've been out there, a lovely part of the world. For those of you that like the great outdoors, Grand Tetons and all that kind of stuff is a great area. But they have their once per year symposium out there. And the Jackson Hole event was noteworthy for how succinct Jerome Powell was with his commentary. I think it was only like an 8-minute speech, and there were no questions afterwards. So he could kind of control that dynamic a little bit more. Tomorrow is going to be more of your typical interest rate decision where you're going to have the reporters in the room and they're going to be asking him questions, and he's going to have to kind of lay out his vision for the future, and people are going to try to determine how close are you to, becoming a little bit more dovish than you have been. And he's going to have to kind of walk that line, and we'll see how the market responds to that. But right now where we stand with the 10-year Treasury yield is we are above 4%. We're at 4.05%. And we are still sitting atop that rising 30-day moving average. However, the background color is light pink, meaning that we do have a weekly bearish posture at this moment in time. And so, again, it's kind of similar to the US dollar, where you can see how this could go either way. This one, I'm a little bit more inclined to think that interest rates have a little bit more juice to the upside. But I could be wrong about that as well. I'm mostly leaning that way because we have not breached that 30-day moving average this entire time going back to the middle August. So, the trend is your friend until the end. And so until you see a break of that, you have to assume that the trend will hold. The other interesting thing that happened from an interest rate perspective here recently is we actually had the 3-month Treasury bill with a higher yield than the 30-year Treasury yield. Of course, we've been talking about inverted yield curves all year long, but a lot of times you kind of get your 2s and 10s inverted, but that is really extreme. When the 3-month yield is more than the 30-year yield, things have gone quite haywire. And a lot of times when you see that type of behavior, a recession is around the corner. So, brace yourself. It doesn't have to be that way because, in finance, there's just not been enough instances throughout history where you can say for certain that something will happen because, inverted yield curves are pretty rare, right? You could probably count them on a few hands in terms of how often they've happened throughout history. So just with a lack of a lot of data points, you can't, bet the farm that it's going to happen every single time into the future. But what we do know is that typically throughout history, when there has been the rare event of an inverted yield curve, recessions generally follow that. So we could very well be heading that direction here once again. Let's go ahead and talk about oil now. Oil had a nice day. It was up 2.22%. And so again, that's kind of helping some of those companies like your Marathon Petroleums and your Chevrons and your Exxons and what have you. Notice that oil looks quite a bit better than gold. It was interesting. I retweeted something on Twitter here, I think it was earlier today or yesterday, talking about how gold has not had this type of a streak of down months since the 1800s. I think it's been down like 7, 8, 9 months in a row, something like that. And so it's been really bizarre to see how gold has done so poorly in this inflationary environment when a lot of people would have expected them to do the opposite. And of course, part of the reason behind that is the US dollar has been so stubbornly strong that commodities priced in the dollar have a little bit more weakness than they would otherwise. And so as you can see, gold was also up today like oil was, but gold remains below their falling 30-day moving average. They continue to have this strongly bearish posture, whereas it's the reverse with oil. Oil has a strongly bullish posture and is above its rising 30-day moving average. In terms of some of these other areas, we did have Treasury bonds increase here today. Not tremendously. Again, it was pretty quiet on the bond market, and it has been really for the last 3 or 4 days as we await more information tomorrow from Jerome Powell. In terms of preferred stocks, they actually kind of rolled over here today. We don't talk about them a lot, but this is somewhat noteworthy because we do have a close below the low of the high day, and we do have a continuation of that downtrend on preferred stocks there. So it looks like the path of least resistance continues to be to the downside there with that strongly bearish posture. We did have the foreign markets actually up here today. The dollar was down, so remember that can help foreign securities. When the dollar is down, the foreign securities tend to do a little bit better than the U.S. securities, and that did play through here today. EFA, which tracks the developed foreign stocks, was up 0.79%, and then EEM, which tracks the emerging foreign stocks, was up 1.84%, so a pretty healthy day there for the emerging market stocks. There's been a lot, of course, of chatter back and forth about China. China is the country that kind of drives what's going on with the emerging markets right now. There's been some buzz here and there about how, perhaps they might be a little bit more open-minded towards using some of those mRNA vaccines and some more Western medicines as opposed to kind of the hardline approach that they've been taking here over the last couple of years, where they pretty much are willing to shut down their entire economy as soon as somebody has COVID. It sounded like they even had an incident over at Shanghai Disney where just one person had COVID and they had to shut down a big part of the park, and you hear stuff about that at their casinos in Macau and stuff like that as well. So the market doesn't really like that because naturally there's a lot more volatility in the unknown of not being able to run your business the way you as a business manager want to. If you know that the government can just come in and just shut you down just because somebody walked into your store with COVID, then it's hard to kind of gauge out the future there. So if anything, just a little bit more clarity would be helpful in the economic activity of China, and maybe that's coming to light here to a degree with some of those rumors flying around today. Let's go ahead and take a look at what's going on with the sectors, and that will be chart 5C. And as this pulls up here, you can see that there's only 2 pink charts left on the board. That's communications and that's discretionary. And remember, those are 2 very important sectors because of their market cap weightings. Remember, discretionary is where you're going to find Amazon and Tesla. And remember what I mentioned to you earlier. Amazon looked terrible today. They lost their trillion-dollar status. They were down 5%. So no surprise, discretionary was down 1%. Communications was down 0.64%, and they also have a strongly bearish posture here. And remember what I had mentioned earlier today about Alphabet being down 4%. So Alphabet and also Meta, of course, has added to the intense selling of the communications sector here in the last week or so, with a lot of those mega caps coming out with earnings that the market has not found too enticing. And so those two areas are very important areas of the market, and they both started to sputter a little bit. So that's not really helping the bullish cause out there. You can also see that technology was down today. They were down 0.84%, with stocks like Apple and Microsoft also struggling today. However, unlike communications and discretionary, technology has managed to retain its strongly bullish posture for the time being. Notice that technology remains above its 30-day moving average, whereas communications and discretionary have not. And both of those are below their falling 30-day moving averages as well. They're the only two that not only have strongly bearish intermediate postures on the market forecast, but they're also the only two that has a currently red moving average with price below the falling moving averages. The other charts on the board are all green, but naturally, not all of them look as good as others. The chart that probably looks the best, stop me if you've heard this before, but it is energy. Energy, of course, breaking to new multi-month highs here today, and has the strongest looking sector chart on the board. But to be fair, there's been a couple of areas that have started to perk up a little bit more nicely, financials being one of them, and then also healthcare has done a little bit better here recently as well. Healthcare is not that far away from breaking out to multi-month highs and joining energy in that pursuit. So they are likely to be the next sector to achieve that, given the information that we have in front of us right now. In terms of what sector did the best here today, let's see. It looks like it was energy as well. It was up 0.97% today, so not quite 1%, but nonetheless, it was a fairly strong day considering the alternatives out there, where we did have some of those key sectors in the red. And of course, the whole market, the S&P 500 was down 0.44% today. But as you look at each of these individual sectors, let's count them out. We had 1, 2, 3, 4, 5 of those sectors that were actually in the green. So if you didn't know any better, you might have thought that most stocks were down today, but that just simply wasn't true. You actually had some pretty healthy areas of the market, including energy. All right, let's go ahead and now talk about our trade application example. And I'm going to pull up just a normal swing trading chart here. And as I mentioned before, I'm going into tomorrow's FOMC meeting with a little bit of skepticism. And so I hope I'm wrong about that, so I'll put that out there as well. Sometimes you hear me use the phrase that I'm willing to provide some sacrificial lambs. And what I mean in this particular instance is I hope the stock market just erupts, right? I hope it goes up forever. If it does, I'll be a happy camper because that's where my long-term money is. But I'm also a realist. And given my considerations that I mentioned to you earlier about the Fed being in its quiet period and us going a little bit too far too fast on the upside, maybe being counter to the goals of Jerome Powell, I just fear that tomorrow could be one of those days where we do get a little bit of a sell-off. And I want to be somewhat prepared for that, knowing that, of course, we have plenty of bullish trades that are going on at any given moment in time. Sometimes it's a little bit harder to get a bearish trade here or there unless the setup is right. And as I was looking at the 4 different indices out there, as I mentioned before, the NASDAQ looks like it's the one that is the most prone to a sell-off. That's where you're starting to see more of the weakness compared to the other indices out there. So naturally, there's a lot of tech stocks in the NASDAQ. So I started going through a few of those charts, and I landed upon CrowdStrike. Now, this is a pretty interesting company, one that's been a really excellent growth stock over the years. So, I just want to put that out there. Sometimes people think that when you take a bearish trade on a stock that somehow you hate that company or something like that. And that's just not how it is, right? We're here for the opportunity that is presented without offering any commentary about how good or bad any particular company is. So to be fair, if you look at a 10-year chart of CrowdStrike, it's been a beautiful thing, or at least it had been for a while. I guess it's broken down here in the last year, but this was one heck of a run for CrowdStrike. It was a prominent growth stock during this moment in time from March of 2020 till pretty much the end of 2021. Great looking chart. But you can see how things have reversed course here in the last year or so. Remember, the NASDAQ topped out in November of last year, so we're almost at the 1-year anniversary of the NASDAQ topping out. It probably feels longer than that, but we actually have not been in bearish conditions for over a year at this point. It's been slightly under a year. So like the NASDAQ, CrowdStrike also topped out last year in November and has been in a downtrend ever since then. So let's go back over here to our 3-month view. And you can see here that it's kind of established this pattern of lower highs and lower lows. And they're pretty well defined, right? You have a high back here in August, you have a lower high, you have another lower high, you have another lower high, and I'm hoping, for this trade's sake at least, that this is yet another lower high that's starting to be established right now. And of course you can see the lower lows as well. There's a low, there's a lower low, there's another lower low. We've had our reversion to the mean. We're struggling at the moving average, just like we did back here, just like we did back here. And the end result of both of those struggles was a rolling over of the stock price. And so I wanted to play this one a little bit more aggressively, and I actually just bought a put on it. And for those of you that have watched me in this video over the years, you'll know that that is incredibly rare. I don't do that very often. There's probably less than just a handful of times throughout the year that I do that. In this case, I felt like I wanted to speculate a little bit more, just because of my opinion of what could happen tomorrow. But I also wanted to recognize that my opinion might be wrong. And while I'm expecting volatility, and much of that volatility to the downside tomorrow, what if the volatility is to the upside? Well, in that case, you would be in a little bit of a bind if you were just short selling a stock. Because remember, a stock can go up forever, and it can only go to zero. So you have to be a little bit more cautious when you're a short seller because of the infinite risk that you are taking. When you buy a put, which is a bearish bet on that stock to the downside, you are limiting that possibility because you have defined risk. The only money you can lose is the amount of money you paid on that put. That's the good news. The bad news is, like so many wasting assets, whether it's a call or a put that you buy, time decay is your enemy, not your friend. And so you do have to be more directional in that situation, and you can't just have a stock that goes sideways. You do actually need that stock to come through for you and go in the direction that you want it to. So this one is a little bit more speculative from me, a little bit more directional, a little bit more aggressive than I typically will go, but decided that the moment seemed a little bit more right here in front of an FOMC decision, and therefore was willing to go in that direction and just see how it goes, right? And if it doesn't work, so be it. But in this case, I did a November monthly contract, and I did the at-the-money strike, the 160s. And so if we can get this stock to come back down here to below 150 and kind of follow this pattern that it's had before in the next 3 weeks or what have you, then that can be a nice winning trade. If it doesn't, if it rips higher, or if it goes sideways or what have you, then I know what my worst case scenario is, and that's how much I paid for that put. And remember, we always telegram out to our premium members what the put strike prices are and what the execution and fill prices are, and all that good stuff is a perk to our premium members there as well. So make sure you're paying attention to Telegram, because who knows, maybe I end up getting out of this trade relatively shortly as well. And if I do, I will let all of you know in that Telegram app for those of you that are our premium members. Okay, so that's what I have for you. Hope you enjoyed the presentation here tonight. Buckle up. Tomorrow should be a very interesting day as we hear from Jerome Powell and company about the interest rate decision. We've had a heck of a run here over the last month or so, but it's a possibility that we might need to give some of those gains back. So if we do, then we do have a few of these bearish trades that can work for our benefit there. So if you enjoyed tonight's presentation, I ask one simple request out of you. Click like for me there on Twitter. It only takes you 5 seconds. It doesn't cost you a penny. And as long as we're up and over 100 likes by the time I'm scheduled to do this video again on Thursday, I'll be happy to give you another full-length video that includes a trade application example like this one. On the other hand, if you don't like these trade application examples and you only want to hear from me for 15 minutes as opposed to an hour, then don't click like. And if we're under 100 likes, then I'll be more than happy to just put in the 15 minutes. It would save me a lot of energy and work if that were the case. So no problem there at all either. We'll let you guys decide collectively what you prefer in that regard. David should be back with you tomorrow night to give you his opinion on the FOMC announcement, and then I will see you in some venue here a little bit later this week. So until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.